If you have been wondering how the insurance company charges policy loan interest, why they send an interest bill when you're already making loan repayments, or what will happen if you don't pay the loan interest, this video is for you. If you have other questions related to policy loan interest, or just want a better understanding of how policy loan interest works, you're in the right place because our subject is policy loan interest. The first question is, how do insurance companies charge interest? Some insurance companies charge interest on policy loans in advance, and some charge interest in arrears. But regardless of how the interest is charged, the insurance company will only bill you for loan interest once a year, and that's at your policy's anniversary date. Let's suppose a policy has an anniversary date on January 1st, and the policyholder takes a loan on July 1st, 6 months after the policy's anniversary date. An insurance company that charges interest in advance will hold back from the available cash value enough money to cover the loan interest on this loan until the policy's next anniversary date in January. Then, on January 1st of the next year, if there is still a loan outstanding on the policy, the insurance company will bill for a full year of interest to cover from the current anniversary date to the next anniversary date. An insurance company that charges interest in arrears will not hold back value to cover interest until the next anniversary date, but when the policy's anniversary comes around, they will bill for the interest needed to cover the loan from the date it was taken until the current anniversary date. If the loan was paid back before the anniversary date, a company that charges interest in advance would credit to the available cash value the portion of interest they held back that was not used. A company who charges interest in arrears would include the amount of interest needed in the payback amount. We can see either way the insurance company is getting the interest they need for the loan. It's just the method for charging interest that can differ from company to company. Here's the next question. Why does the insurance company send me a bill for interest when I'm already making monthly loan repayments? It's because the insurance company only bills for interest at the anniversary date of the policy. And since a policy loan is an interest-only loan, not a conventional loan, any money the insurance company receives for loan repayment throughout the year is applied to principal only, not interest. The only exception would be if you were completely paying off a loan and your insurance company charges interest in arrears. They won't send you a bill for interest in the middle of the year, but they will apply an interest payment if you're completely paying off the loan. This brings up another question. If I'm making regular monthly loan repayments, do I have to pay the interest bill at the anniversary date? Not necessarily, but here's how to know for sure. Divide the interest amount shown on that bill by 12, and then compare that number to your monthly loan repayment amount. If your monthly loan repayment is greater than the divided loan interest bill, you do not need to make an additional payment for the interest when you receive the bill, and I'll explain that in a moment. But if your monthly loan repayment is less than the divided loan interest bill, then yes, you should pay the interest bill when you receive it. The next question is, what happens if I don't pay the interest? If you do not pay the loan interest, the insurance company will add the interest that's due to your outstanding loan balance. If you are not making any loan repayments, this could lead to trouble as it sets up an interest compounding on interest situation that is not in your favor. But if you are making loan repayments that exceed the amount of interest the insurance company charges each year, this won't be an issue at all because you are reducing the principal at a faster rate than the interest is accumulating. Many of our clients intentionally do this with their policies. They choose a loan repayment amount that will exceed the annual interest charged by the insurance company, and then they make regular monthly payments. By doing this, they know the interest is being covered, and they don't have to worry about making a separate interest payment when the bill comes in the mail. Now the last question. Is there a penalty if I don't pay the interest? If we're talking penalties as in losing access to certain features or benefits of your policy, no. However, if you aren't making any loan repayments and you aren't paying the interest when it comes due, this sets up a situation where interest is compounding on interest, and over time that can destroy a policy, so be aware. But if you are making loan repayments that exceed the interest the insurance company is charging, and you choose not to pay the interest bill, that's totally fine. There are no penalties or potentially dangerous situations being created by using that approach. We hope this video was helpful to you. If you have any questions you'd like us to answer, email us, team@mcpheeinsurance.com. If you would like to get a life insurance policy, or if you have a life insurance policy you want us to review, contact us. We are licensed in all 50 states, and we are here to help you.